Welcome back. My name is Arya. I don't waste your time. Let's get straight into it. If you were to artificially create the ideal business in a lab environment and assign it with the best qualities that you could possibly think of, you would end up with Fair Isaac Corporation. Fair Isaac Corporation, otherwise known as FICO, benefits from massive scale economies, an incredible brand that they've nurtured over the past 60 years, and additionally, incredible network effects, which only are going to get stronger as time progresses on. FICO is one of my favorite businesses that I've ever analyzed, and in today's video, I'm going to make the case why I absolutely love this company. With that being said, we're going to go over the earnings report, which was the catalyst for the stock selling off. Additionally, as always, we're going to go over some of the financial metrics and look at the company from a fundamental perspective. Of course, we're going to go through my free cash flow to growth spreadsheet that I include in every single video, and we're going to go over actually the master spreadsheet because I had one of you guys request that. At last, we're going to go over the valuation of the company, which is sky high. The valuation, in my opinion, a little bit of a spoiler for the episode, but is the single biggest risk factor for this business. It's not execution risk. They're executing on all fronts. It's in fact the valuation, and I have quite the example that I'm going to follow up with later on in the video. With that being said, I wanted to start off with this episode from Dev Kantasaria. Dev Kantasaria is an incredible investor. He manages the Valley Forge Capital Management portfolio, and he's done multiple podcasts on YouTube and on Spotify everywhere, which I highly recommend. I especially recommend this episode where he dives into FICO, which is in fact his biggest holding at roughly 30% of the portfolio. But yeah, I'm going to leave this in the description. It's an incredible podcast, and I've personally listened to it over 10 times. I want to draw your attention to one segment of the podcast here where Dev goes into what the business actually does. And of course, many of you guys are probably familiar with FICO. FICO does provide the credit scores, which are used in loan originations all throughout mortgages, car loans, personal loans, everything to do with credit scores and loans and all that type of stuff. So Dev here, he mentions, today, the revenues of the company are evenly split between scores and software, but scores provides over 75% of the operating income of the company because that side of the business has much higher margins. But as background, the company, as you mentioned, has two main business lines. The first is its consumer credit scores, which help assessing credit risk for consumer loans, such as mortgages, autos, credit cards. And by the way, mortgages, autos, and credit cards, it's split evenly, 1/3, 1/3, and 1/3. That's going to be important for the analogy of why I believe this company could continue its growth rate later on in the video. The second line of business is software. This portion of the business delivers data analytics for things like loan originations, fraud detection, customer management, customer communications. The company is evenly split in terms of revenue between these two pieces. If we talk about scores first, FICO scores are a common language used by various different industry participants to talk about the credit quality of a loan or a consumer. So as you guys know, FICO scores, so like your 600, 700, 750, whatever the case is, it is a language protocol moat. What that means is that because it's so commonly referred to in the world, such as like, oh, what's your credit score? It's a 700, it's a 720, whatever. That provides FICO this language moat, and it provides network effects whereby as more people refer to FICO scores in the financial world, then it's going to the moat is going to get stronger. The network effects get stronger with each additional user that it joins the network. He goes on to say, to date, it's the best way that we have to assess and monitor consumer credit risk. He's not wrong. Another thing that I might include later on in the video is the Gini coefficient. The Gini coefficient is a measure of how accurate a scoring model is compared to other scoring models. Spoiler alert, FICO has the best Gini coefficient out of any scoring model ever. Today, over 250 million Americans can be scored using a FICO score, and scores are very inexpensive, generally less than $1, and some scores are even a penny or a fraction of a penny. Depending on the use case, to give you an idea, the far reach of FICO scores, they're used in over 90% of credit lending decisions. That's incredible. 90% of lending decisions are made using a FICO score to assess whether or not that person that is borrowing the money is creditworthy. They're used at over 99% of credit securitizations. 90 of the top 100 largest US lenders use FICO scores, and it's not just lenders. There's over 700 insurers that use FICO scores, 1/3 of all retailers, more than 200 governments, more than 100 pharma and healthcare companies. So FICO scores have found many uses over time. He's not wrong. FICO scores are used in all facets of the world, right? They're, as you mentioned, are used in insurance companies, are used in retail, governments, and pharma and health, right? We need to know as a business whether or not someone is creditworthy, and FICO does that best. Now, I want to draw your attention to my analogy that I've cooked up for you guys, which I know you guys absolutely love my analogies, but nonetheless, I think it's important to establish this early on just to know which parties are involved, because of course we have a pretty good understanding of what FICO does. It's the credit scores for all the different consumers in the world, and well, not the world, just North America for the most part and some parts of Europe. But anyways, it's the credit scores which then provides the credit worthiness to the lenders and all that type of stuff, right? But I really want to establish the four parties involved with FICO early on, just so it makes sense later on in the video. Of course, the first party involved is you and I, the average person that's borrowing some money. So I'm going to write borrower here. And this could literally be anything for any reason, right? It could be me borrowing for perhaps my student loans or a car loan that I want to buy a brand new car. It could be a personal loan, right? You want to borrow some money for whatever your needs are. Or, of course, the mortgage that many people are borrowing to buy a house, right? That's the first party involved in this. The second party involved in this, as you might have guessed, is the lender. The lender could be any different bank. This could be a secondhand car dealership, right? They might extend a loan out to a possible buyer just so they buy it from them, and then they could finance that and maybe charge an interest rate from that, whatever the case may be, right? The lender could literally be anyone. As you guys just saw in the example that Dev Cantasaria just gave us, it could even be a hospital, right? It could be an insurance company. It could be anyone. So second party involved is the lender. Third party involved, and no, this is not FICO. This is, I'm going to write here, CRA. This is your credit rating agency. So not to be confused with S&P and Moody's, they're credit rating agencies for more corporate and government and that type of stuff. The CRA that we're looking at is Equifax, Experian, and TransUnion. It'll be up on the screen. But as you guys can see, these are the different credit rating agencies, and what their job is to essentially provide a credit history and a credit report on everything that you've ever done. So every time you go out and you buy something on a credit card and you pay it back within a certain time, that all goes all together into your credit report. And this credit report is able to be provided to the lenders. So a bank that's trying to issue you, I don't know, let's just say $20,000 to buy a brand new car for a car loan, they're going to go to Experian or Equifax or TransUnion and say, hey, we have Aria over here. He's trying to borrow $20,000 to buy a car. And what I need from you is the credit report on Aria. Can you pull the credit report of everything Aria's ever done with any of the banks, and every time he's bought a pack of gum at the convenience store, everything that Aria's done, I need to know it. I need to know whether or not he is creditworthy. From there, the credit rating agency is like, hey, well, I could pull everything that Aria's ever done, but I'm missing one integral piece to this puzzle. And that is, of course, the credit rating itself. That is where our beautiful FICO comes into play. So FICO then takes all the credit information that the CRA has compiled on me and then puts it into their fancy algorithm. And from there, they're able to spit out a number, call it 850, because I have an incredible credit score, right? So then they're able to provide this credit score to the credit rating agency, CRA, right? Again, this could be TransUnion, Equifax, whoever. And CRA is able to put it into their credit report and then give it back to the lender, which could be the bank, the hospital, whoever it may be. And from there, the lender is able to make a credit decision whether or not Aria is able to borrow the $20,000, which of course I'm able to borrow the $20,000. I have an incredible credit score. Anyways, I hope you understand. So FICO is the last piece of the puzzle. They simply take all the information that is compiled on any different borrower and they put it through their algorithm, and from there, they're able to gauge how creditworthy that individual is. Whether they're not very creditworthy, so like a 350, or they're extremely creditworthy, it's like a 850, 900, right? So FICO is simply the algorithm to determine creditworthiness of any different borrower. With that being said, I want to draw your attention to why Fair Isaac actually sold down recently, right? So of course they had their Q2 earnings report, and I'm not going to spend too much time on this. I just want to draw your attention to a couple different things. First of all, as Dev Cantasaria mentioned, scores and software are roughly split 50-50. But what's interesting to note is that scores revenue, which has historically been the slower growing piece of this company, was actually outpacing the software side by roughly double, right? Just a little bit more than double. So 19% compared to the 8 from the software side of the business. Total revenue is up 14% on a year-over-year basis, right? So as you can see, incredibly fast-growing company with an incredibly wide moat. Now, I want to also draw your attention to the EPS growth, roughly at 28%. This is going to be more important on the valuation side of things later on in the video. And another interesting thing I saw was mortgage originations were up 85% compared to last year. Really interesting considering that we haven't had rate hikes, or I guess the rate cuts go down or anything like that. Nonetheless, mortgages seem to be booming, at least from FICO's data over here. Another interesting thing that I wanted to point out is this slide that they have here on DBNRR, which stands for dollar-based net retention rates, or just net retention rates for shorter. NRR is basically if you were to take all the software that FICO was able to sell last year and compare the dollar amount to which they sold this year, how much additional software did they sell last year to this year, right? So 100% would represent that they were just simply able to keep all the customers that they had last year, and that's it, right? So 0% growth year over year. 12% here, which is what FICO has. That means that not only were they able to retain all the customers from last year, but to the same customers, they were able to sell an additional 12% via price increases, via additional software, whatever the case may be, right? This is an interesting KPI to track for FICO to see roughly how well the software side of the business is doing. But anyways, I just wanted to point that out. 112% is a very healthy net retention rate for FICO. Moving on, just some quick financials for those of you who are not very familiar with FICO. Margins. FICO has incredible margins, right? Each additional score that FICO runs through their algorithm doesn't cost them much. With that being said, gross margins 80%, operating margins 43%. I'm going to draw your attention to this operating margin at 43%, and I've already pulled it up for you guys here. But as you can see, since 2019, FICO has had operating margins expand from 22%, which is incredibly healthy, right? The average S&P 500 roughly at 10-12% operating margins, all the way up to 43%. Almost double. Their operating margins have almost doubled since 2019, right? 5 short years ago, the operating margins were half for FICO. Additionally, free cash flow margins of 30%. That's something interesting to know. I'll come back to that later on. Return metrics, ROCE of 40%, absolutely incredible. And it doesn't lack on the growth side of things, right? From the growth side of things, as we just saw in the investor presentation, the earnings per share in the next 3 to 5 years is estimated to grow at 18%, and the earnings per share in the next 2 years expected to grow at 22%, right? So all around, looks great. Arya, what's the flaw? The flaw is the sky-high valuation on this company. PE, which isn't a metric that I like to use too much, is 60. Price to free cash flow is 58. And that's a little bit misleading because they have an incredible amount of stock-based compensation, which we'll look at in a second. But again, I want to draw your attention to the operating margins. Why did the operating margins expand so rapidly? The reason for that is the pricing power that FICO has had in the past 5 years. And only in the past 5 years have they actually started increasing the prices on all these different scores that they're running. So historically, for the past 30 years, or I guess however long that FICO's been in business, FICO has only grown via the number of scores that are ran every single year is increasing on a year-over-year basis. Every single year, FICO has done more scores than the previous year, and that's how they've organically been able to grow for the past however long. But as of 2019, I believe there was some legislation that was passed for FICO to actually be able to start increasing these prices. So again, I'm going to go back to the handy dandy Paint app by Microsoft here, and I should have probably mentioned this earlier, but FICO has 3 different segments on the score side of things, and they're roughly 1/3 each. So of course, they have the credit cards, which I'm going to just write CC for simplicity's sake. They have mortgages, right? And they also have personal loans, right? So I'm going to just write PL, personal loans. This could be your personal loan to just take out, borrow money, whatever the case is, or car loans, all that type of stuff. So as of 2019, what FICO started doing is increase prices on all these different ones. So previously, let's just say it costs $1 to run each different one, right? This isn't actually how much it costs, but I'm just saying for simplicity's sake and analogy's sake, it was $1 per segment, right? Starting in 2019, what FICO started to do was increase, and I'm going to do this in green here just so it looks different. They started to increase the prices of each individual segment by 30%. So in 2019, they increased the price of credit cards by 30%, and they kept the other segments flat, right? So they kept mortgages flat, and they also kept personal loans like car loans and all that type of stuff at 0%. Then in the following year, they kept credit cards flat, right? So it's still a 30% increase in the prior year, but instead they increased the prices on mortgages. Again, I'm going to remind you, this is 1/3 of the score side of the business, but 30% on 1/3 of the business is 10% for the entire business. The year after that, they had a 30% increase on the car loans side of the business. So as you could see, they're roughly increasing 30% in each individual segment every single year. That averages out to 10% total for the score side of the business. And this is the thesis with FICO. FICO can increase these prices because it's like $1 for a score on a 20,000, sometimes with a car, it's like a 400, 500, $600,000 lending decision, right? So they're able to increase these prices, and the credit rating agency is more than happy to pay it. And the credit rating agency simply passes on that price onto the lender, and the lender probably charges some type of admin fee for like 40, 50, 60 bucks when they're lending out $600,000 for a mortgage, right? So ultimately, they just pass on these tiny little fees of $1, $2, $3 that nobody really cares about because the lending decision is so big onto the consumer, and the consumer is happy to pay that $40 admin fee for a credit rating file to be pulled just because they're borrowing so much money, right? So ultimately, the thesis with FICO is that they can increase these prices way above the average rate of inflation, and that has led to operating margins expand nearly double. So, with that being said, this is a company that has excellent margins, excellent return metrics, has a very long runway of growth ahead of them, and can increase their prices ahead of the rate of inflation for a very, very long time. Aria, what is the caveat with this business? It would in fact be the sky-high valuation. As I mentioned earlier in the video, FICO trades at a very, very high price to free cash flow and PE multiple. And while 58 times price to free cash flow is extremely rich, it is a very fast growing company, so maybe that's justified. Not really, because of the amount of stock-based compensation this business is issuing, especially on the software side of things. So roughly 20% of their free cash flow is ate up by the stock-based compensation that the company issues. What you end up with is when you go over to my investable universe free cash flow calculator, which if you didn't know, it's similar to the PEG ratio. So we take the free cash flow multiple that the company is trading at, and we divide it by the growth rate, and that spits out this incredible column here, whereby you could compare the different businesses to see if the valuation is justified for the amount of growth you're getting. For FICO, adjusted for stock-based compensation, they're trading at just shy of 90 times free cash flow. And if we assume a 25% growth rate for this business, which again, going back to the investor presentation, they just grew EPS at 28%, but I'm saying free cash flow grows at roughly in the same ballpark, maybe in the 25% range, whatever, you end up with a 2.67 times multiple, comparing the current free cash flow, price of free cash flow valuation divided by the growth rate, right? So again, not too great, even if we assume some very rosy things about this company. Even if we assume a very, very fast growth rate, the business seems to not be trading at a valuation that would personally interest me. With that being said, at what price would I get interested? Just to play around with these numbers, it seems that maybe in the 800 to roughly, 800 to 850 range, if FICO were to get to that share price, it would be a more attractive buy. It would be closer to my green zone here, whereby we're getting the valuation to be twice the growth rate of the company. I hear you guys. Some of you guys might be saying, well, it's a company with a very long runway of growth. It has a lot of pricing power. I'm going to buy into the company. Before you make that type of decision, I want to draw your attention to this is the valuation chart of FICO. And what this does is we could see the price to free cash flow that FICO has been trading at historically over any given time period. As you can see in the trailing year, FICO went from trading roughly at 40 times cash flow all the way to a peak of just shy of 70, and now at roughly 60 to 56-ish times cash flow. And I want to stretch this out to maybe 5 years. As you can see in the past 5 years, again, in 2020, it was a little bit rich, but it seems that the growth rate caught up to the company and it got better on from there. They troughed at roughly 22 times cash flow. You could have bought this company at 3 times less what the valuation is today. And again, if we stretch this out even more, it's probably going to look worse. Yeah, as you can see, this was a company 10 years ago that was trading at 15 times cash flow. Of course, I understand the company's drastically different from back then, but nonetheless, what you have to understand is if you're looking in the rear view mirror and you're seeing incredible gains, especially stock price appreciation wise, we have to understand is a lot of those gains are simply from investors valuing the company's cash flows more highly, bidding up the stock price more and more, and that drives up the valuation of the company. Again, going out even further, you could see that at one point, This was a company that was trading in the single-digit price to free cash flow. What you have to understand is that this may not continue out into the future. Back when it was a 20 times, 10 times, 15 times multiple, you could reasonably expect that the multiple would expand over time and that could provide you some gains. And the complete opposite is true if you're buying in today. If you're buying in today at an all-time high price to free cash flow valuation, you're assuming an incredible amount of risk, not from the company's execution side of things. I think FICO is going to continue growing more and more, and they're going to continue increasing prices. No problems on that front. What you have to understand is the valuation risk that you are assuming. I'm not sure if you guys are familiar, but Paycom is a payroll type company, and this was a company that previously traded at very, very high valuations. This was a company that was trading over 100 times PE, and again, very high valuation. And what had happened is the growth slowed down, and the thesis was broken with Paycom. And overnight, Paycom was down nearly 40%. If we stretch this out to a year, you could even see that prior to that, they had a bad earnings report, and the stock had dropped roughly 20% in one day. And then later on, again, it would drop another 40% the following quarter, right? So we have to understand with companies like these, where the valuation is sky high, is all it takes is one bad catalyst, and the stock could come crashing down. And I don't know about your personal investor psyche, but it could be really difficult to try to hold on to those companies and not sell out when it drops 40%. With that being said, I'd be curious to hear what you guys have to say about FICO. FICO is an incredible company, and as I mentioned at the very start of this video, it's one of my favorite businesses to analyze. Still, the valuation is incredibly high, and that is what is personally holding me back from making a purchase decision into FICO shares. I'd be curious to know your thoughts, which you could leave down in the comment section below. And also, I had one of you guys mention that you wanted to see my master investable universe, so like all the different companies that I analyze in my free cash flow growth calculator, and this is it. This is on screen now, so go ahead, take a look at it. These are all the different companies. Of course, some of the growth rates I had to assume and some of the stock-based compensation things. So it's not perfect, but nonetheless, as you can see, UNH and Evo Gaming, some of the cheapest companies in the master free cash flow calculator. And of course, you got Tesla all the way at the bottom there. Tesla, yeah, 14 times their growth. So not exactly the best investment in my opinion. That could be a later video that I can make. Also, kind of a final thing, I'd be curious for you guys to give me episode suggestions and that type of stuff. I love when you guys leave me comments. So yeah, feel free to shoot. And even if you have any criticism about this YouTube thing, I'm just starting out. So of course, I'd be interested to hear your criticism and your thoughts and ways I could improve. Anyways, with that being said, thank you for watching. Have a great day.